The market cipher here. Silver is holding $84.70 as the Middle East explodes into the largest regional war since 1973. The Strait of Hormuz is effectively closed. 20% of the world's daily oil supply is now offline. Iran is firing missiles at U.S. military bases across 8 countries. Israel just struck oil storage facilities in Tehran. Oil spiked 12% in a single session to $90.90. Gold briefly touched $5,400. Let me say that again. Gold touched $5,400. And silver? Silver is holding the line at $84.70 after jumping 3% in 24 hours. Today's intraday high hit 85.33s. Today's low tested 81.78. The 50-day moving average sits right at $84. This is the exact level where the battle is being fought right now. And what happens tonight could change everything. And here's why I say you should be paying attention. Because we mapped this exact level before it happened. In the last video, we identified $84 as the critical battleground where the 50-day moving average would act as support or resistance. That's exactly where price is sitting right now. Not $80, not $88. Exactly the zone we outlined. If you're new here, welcome to the Market Cipher. Make sure you're subscribed with notifications on. I don't sell courses. I don't run paid signals. I don't manage money. I don't pitch investments. Just verified data to help you think for yourself. That's what this channel is about. Independent thinking, not following the herd. If anyone else is using my name to sell you something, they're a scammer. Ignore them. Comment below with your price target for silver this week. I read every single one and I'll address the best questions in the next video. Now let me be clear about what's unfolding. This is not a contained strike. This is not a limited engagement. This is a full-scale regional war entering its second week with no ceasefire in sight. Operation Epic Fury launched on February 28th. U.S. and Israeli forces conducted 900 strikes in the first 12 hours alone. Supreme Leader Khamenei was killed in the first wave, along with dozens of top Iranian officials. The IRGC's top commander is dead, and Iran is retaliating with everything they have. On March the 2nd, Iran declared it would attack any ship attempting to pass through the Strait of Hormuz. On March 3rd, Iran largely halted all oil and gas exports through the strait. The Guardian confirmed it. On March 8th, today, Qatar declared force majeure on gas exports after Iranian drone attacks hit their facilities. Israel struck oil storage sites near Tehran. Iran struck Israeli oil plants in Haifa. Dubai International Airport was damaged by drone strikes and partially shut down. The timing is suspicious. Fortune is calling this the nightmare scenario, the biggest oil output disruption in history. And it all happened the same week silver was testing its 50-day moving average after a 40% crash. Coincidence? You decide. Trump demanded Iran's unconditional surrender on March 7th. Iranian President Pezeshkian responded today, Iran will not bow. Hezbollah has resumed full hostilities with Israel from Lebanon. A Hezbollah drone struck a British Royal Air Force base in Cyprus. NATO forces shot down an Iranian drone near Turkey. The Houthis in Yemen are bracing for war. This is escalating by the hour. And the markets are responding exactly as you'd expect during a black swan event of this magnitude. Gold touched $5,400 on Monday before pulling back to $5,170. JP Morgan analysts explicitly cited a risk premium jump as investors digest the reality of a prolonged regional war. The VIX spiked 33% overnight and hit an intraday high of 28.15, the highest reading since November. The S&P 500 dropped as much as 2.5% intraday before partially recovering. Oil surged to $90.90 WTI and $92.69 Brent, and silver is holding steady at $84.70 while the world burns. Here's why this matters for silver specifically. This isn't 1990. This isn't 2020. Let me explain the difference. During the 1990 Gulf War, silver actually dropped slightly. The LA Times reported silver fell to $4.84 an ounce as gold rallied to $403. Silver didn't participate in that safe haven trade. During the 2020 Iran tensions after the Soleimani strike, silver gained approximately 1%. 1%. That was a single targeted strike with limited escalation. Markets priced in de-escalation within days and moved on. This time is categorically different. The scale is incomparable. UBS analysts are comparing the downside scenario to the 1973 Yom Kippur War, the event that triggered the Arab oil embargo, massive stagflation, and ultimately set the stage for silver's parabolic run to $50 in 1980. That's the historical precedent they're reaching for. Not 1990, not 2020, 1973. And here's what makes 2026 completely different from every prior Middle East crisis. Silver has already rallied 320% from $29 in early 2025 to $121.69 on January 29th of this year. It crashed 40% from that high during the margin squeeze we covered in the last video. and now it's consolidating at 84.70 while the world's most critical oil choke point is closed. The structural setup going into this crisis is nothing like any prior conflict. The COMEX is already under severe stress. Physical demand was already overwhelming paper supply. Shanghai was already paying massive premiums for metal. The banksters were already shorting into a shortage. And now you're adding a black swan geopolitical event on top of an already explosive physical market. This is the same playbook, different decade, same structural conditions. Let me show you the current state of the physical market. COMEX registered silver inventory stands at 81.7 million ounces. Let me say that again, 81.7 million ounces. That's down 22.3 million ounces in the last 30 days alone, a 20.7% drain in 1 month. Total vault outflow over 30 days is 56.6 million ounces. At current withdrawal rates, that's approximately 80 trading days of supply remaining. 4 months. Then what? The COMEX stress index sits at 81 out of 100, near its all-time high of 88. The coverage ratio is 14.4%. Historically, anything below 15% signals stress. It signals that paper claims cannot be fully backed by deliverable metal. Paper leverage stands at 6.9 times registered silver. There are 567 million paper ounces in open interest backed by only 81 million ounces of real metal. Meanwhile, Shanghai silver is trading around $95, while COMEX shows $84.70. That's a $10 to $11 premium, roughly 12% to 14% above the paper price. During the January crash, that premium exploded to 29%, $22 above COMEX. At the extremes, it exceeded 50%. The premium has normalized somewhat, but remains historically elevated. Physical buyers in Asia are still paying significantly more than paper prices to secure actual metal. That divergence tells you everything about where the real price discovery is happening. The paper market says silver is worth $84. The physical market says $95. Which one is lying? Connect the dots. Now let me connect the dots on why this geopolitical event could accelerate the physical squeeze. The Strait of Hormuz handles 20% of the world's daily oil supply. When that supply is disrupted, inflation expectations surge. When inflation expectations surge, real assets like gold and silver become more attractive. When gold and silver become more attractive, physical demand increases. When physical demand increases into an already stressed delivery system, you get delivery failures, premium explosions, and eventually, paper price catches up to physical reality. This is exactly what happened in 1979-1980. The Iranian Revolution disrupted oil supplies. Inflation surged. The Hunt brothers accumulated silver during a period of monetary instability and energy crisis. Silver went parabolic. Now, I'm not saying we're going to $50 tomorrow, but I am saying the structural conditions, monetary instability, energy crisis, physical supply stress, paper market leverage, are rhyming with that period in ways we haven't seen in 45 years. The banksters are shorting into a structural shortage. Every dollar they push the price down, the Shanghai premium expands. Every ounce they short on paper, the physical market absorbs and demands delivery. Every raid they conduct, Asian buyers step in harder. This is a losing trade on a long enough timeline. And the timeline is getting shorter. JP Morgan expects a risk premium jump in precious metals. UBS recommends a modest gold allocation of up to mid-single-digit percentage to buffer against geopolitical risks. Bank of America's scenario range for silver is $135 to $309 by year end. Citi issued a $150 target before the crash and hasn't withdrawn it. JP Morgan's own forecast of $81 average for 2026 has already been exceeded. Silver is trading above their target. These aren't fringe voices. These are the largest banks on Wall Street telling their clients that precious metals are the hedge for exactly this scenario. Convenient timing that they're recommending gold and silver right as their trading desks have likely positioned accordingly. But let me be honest about the short-term risks because balance matters. Silver is currently trading right at its 50-day moving average of $84. If it breaks below $83.50, the next support is $82. Below that, $81 $50. If broader markets continue selling off, if we get a 2008-style liquidation event where everything gets sold for cash, silver could get dragged lower despite bullish fundamentals. The VIX at 28 tells you fear is elevated but not at panic levels yet. If this war escalates further and triggers a true financial crisis, the initial move could be down as leverage positions get liquidated. The dollar is under pressure but still catching some safe haven flows. DXY is at 98.99. The 10-year Treasury yield is at 4.13%. Money is flowing into bonds as a safe haven. If yields spike instead of falling, that would be a headwind for precious metals. If the conflict somehow de-escalates rapidly, if there's a surprise ceasefire, oil would plunge, safe haven flows would reverse, and silver could give back these gains quickly. That's the risk. You need to understand both sides. But here's why I think the probabilities favor higher prices from here. First, there is zero indication of de-escalation. Iran's president said today they will not bow. Trump demanded unconditional surrender. Hezbollah is fully engaged. The Strait of Hormuz remains closed. This has every sign of a prolonged conflict, not a quick resolution. Second, the physical market was already in deficit before this crisis. You're adding a demand catalyst on top of a supply-constrained market. Third, the COMEX is already at 81/100 stress with only 80 days of supply. Any surge in delivery demand, any significant increase in investors converting paper to metal, accelerates the timeline to delivery stress. Fourth, Shanghai premiums remain elevated. Physical buyers haven't stopped. They're still paying above paper to secure metal. That's not the behavior of a market about to crash. The key technical levels to watch tonight and this week. Support, $83.50 to $84 is the immediate battleground. That's the 50-day moving average zone. Below that, $82 is secondary support, $81.50 is deeper support. If we break $81.50, the technical picture deteriorates significantly. Resistance, $85.50 is immediate resistance. Above that, $88 to $90 is the next major zone. $95 and above gets us back toward the January highs. A sustained break above $85.50 with volume would confirm the bulls are in control, and this consolidation is resolving higher. The overnight session tonight matters. Asian markets will react to the weekend's escalation. Shanghai will price in the Iran war developments. If Shanghai silver spikes higher and the premium expands, COMEX will gap up at the Sunday open. If oil continues surging toward $100, precious metals will follow. If there's a major escalation overnight, another attack on oil infrastructure, a strike on a U.S. base, casualties, you could wake up Monday to a very different silver price than you're seeing right now. 3 key takeaways and we're out. Number 1, silver is holding 84/70 as the largest Middle East war since 1973 enters its second week. The Strait of Hormuz is effectively closed. 20% of global oil supply is offline. Oil is at $90.90 and climbing. Gold touched $400. This is a black swan event unfolding in real time. The historical comparisons analysts are reaching for are 1973 and 1979, the events that preceded the last great precious metals bull market. Number 2, the physical silver market was already under severe stress before this crisis. COMEX registered inventory is at 81.7 million ounces with 80 trading days of supply remaining. The stress index is at 81/100. Shanghai is paying 12 to 14% premiums over paper. The banksters are shorting into a shortage, and every ounce they push down, the physical market absorbs. The structural conditions are explosive. Number 3, watch the $84 level. That's the 50-day moving average where the battle is being fought. A break below $82 would be concerning. A break above $85.50 with volume confirms bullish resolution. Watch Shanghai premiums tonight. Watch oil. Watch for any escalation headlines. The next 24 to 48 hours could determine silver's direction for the rest of the month. The unresolved question is this: does the $84 support hold and silver break out toward $90 as the war premium gets priced in? Or do we see a broader market liquidation event that drags silver lower despite bullish fundamentals before the real move begins? Either way, the black swan has landed. The Strait of Hormuz is closed, the war is expanding, the physical market is tight, and silver is holding the line at 84.70, waiting for the next catalyst. Something has to give, and when it gives, it won't be gradual. Wars don't resolve gradually. Oil shocks don't resolve gradually. Physical squeezes don't resolve gradually. The pendulum swings violently in both directions. Be positioned accordingly. Tell me what you're expecting in the comments. Does silver break $90 this week? Or do we see one more flush before the real move? I want to know what you're seeing. Do your own due diligence. Understand the risks. This is not financial advice. If this video added value, share it with one person who needs truth over noise. One person who's trying to understand what's happening. One person who needs data instead of panic. That's how we grow this community. One informed mind at a time. Invest with logic, not hype. The Market Cipher out.